Welcome to video 7 of part 1 of the EA Tax Training free EA exam prep course for 2025. Tom here back with you to discuss specialized returns and topics. Specialized returns is a phrase borrowed from the IRS testing outlines. Essentially, what this video covers is all the miscellaneous individual tax topics that don't fit neatly into any of the other categories. Specifically, what we will cover in this video are amended returns, foreign income and accounts, household employees, marriage and divorce, estate and gift tax, and tax planning. Our free resources from irs.gov, mention the ones in bold here. The first two you're already familiar with. For this video in particular, we've got Form 1040X and its instructions, Form 2555 and its instructions, and then also FinCEN Form 114 and its instructions, which we will be talking about. We have another page of resources, so we've got Schedule H and its instructions, and then Forms 709 and 706 and their instructions. And of course, you have the rest of the forms and publications if you would like more information on those topics. So let's start with amended returns. If you discover an error and want to amend a previously filed 1040, then you do so on Form 1040X. Anytime you see X at the end of a form, that means it is an amended form. You must, of course, file the original return before you file the amended return, which makes sense. And you can file more than one 1040X for the same year. So you're not restricted to just doing it once or twice or any other number. If you find an error, you can file a 1040X. If you later find another error, you can file another 1040X, and so on and so forth. And sometimes it's not even necessary to file a 1040X. If you file your return early before the original due date, and then you discover an error before the original due date, instead of filing a 1040X, you can just file a new 1040. It's called a superseding tax return. You file the new 1040. Your tax software should have a box to check to say that it is superseding the other 1040, and then the IRS will accept the latest one that you filed. But again, you have to do that by the original due date or by April 15th in order for that to work. Let's have a look at the 1040X so you can see what it is all about. You can see the normal information at the top of the return, and then you do have to check your filing status even if it is not changing. And then down here in kind of the heart of the form, this is where you're going to show the numbers that change. So for any of these line items that change, you need to show the amount of the change. So in column A here, you show the original amount that was on your 1040 that you filed. Then you're going to show how much it's changing by on this amended return, and then you're going to end with the final amount. When you're going to do that for all of these different line items, for any of them that change, then you're going to come down to your refund or your amount due. When you are amending, of course, it could be that it's going to result in a refund, or it could be that it's going to result in an amount due. And so this is where you will reconcile that and show that. On page 2 of the 1040X, you can see this part about your dependents. So if anything is changing, you're adding a dependent or you are removing a dependent, then you would show that here. Part 2 is an explanation of the changes. This is important. You do need to explain why you are amending the return. It doesn't have to be long, but you do have to give some sort of explanation. And then also you can see it says attach any supporting documents and new or changed forms and schedules. So if you were changing, for instance, Schedule B for interest and dividends, then you would attach a new Schedule B with the corrected amounts. And then, of course, there are the normal signature blocks, which again is done under penalties of perjury, just like the original 1040 was. So when can you file a 1040X? In general, to amend a return, you must file within 3 years of filing the original return or 2 years of paying the tax whichever is later. Now, you may be thinking, but don't you pay the tax with the return? Well, yes, normally you do, but not always. It doesn't always work out that way. So it is the later of those two that you have to amend: 3 years of filing the return or 2 years of paying the tax. And if you did file before the original deadline, then the return is considered to be filed on the deadline. So if you filed on March 1st, then it will be considered to have been filed on April 15th. So you've got until April 15th, 3 years later, to file your amended return. If, though, you got an extension, then you're going to use the date actually filed. So if you got an extension to October 15th, but you filed your return July 1st, well, then you use the July 1st date. So it would be 3 years from July 1st that you would have in order to amend the return. There are times when you get more time than this to amend. If the taxpayer was physically or mentally unable to manage their financial affairs, if you are in a federally declared disaster area, sometimes the IRS will come out and announce that you have more time. If you were serving in a combat zone or in an area with contingency operations as declared by the president, you could have more time. And then these last two, you will definitely want to know for the exam. If the reason you are amending is due to a bad debt or a worthless security, then you have 7 years from the due date of the return for the year that it became worthless. So sometimes you may have a security, for instance, that becomes worthless, but you don't realize until a few years later, in hindsight, that it was actually worthless a few years ago. And so, for instance, if you had a worthless security that became worthless during 2024, of course, your 2024 tax return is due April 15th of 2025. So you would actually have until April 15th of 2032 to amend your 2024 tax return for that worthless security. Similarly, if the reason you are amending is in order to claim a foreign tax credit, which we will talk about foreign tax credits in this video, but if that's the reason you are amending, then you have 10 years from the due date of the return. So if that was a foreign tax credit that you were claiming for 2024, you would have until April 15th of 2035 in order to amend that 2024 tax return. So you do want to know particularly those 7-year and 10-year exceptions to the amended return requirements for the EA exam. When can the IRS come back and audit your return? Well, we'll talk much more about this in part 3 of this course. But for part 1, you do want to know the general rule, which is the IRS has 3 years from the date the return was due or it was filed, whichever is later, unless you omit more than 25% of your income, in which case they've got 6 years from the date it was filed. Or if you commit fraud, then there is no limit. This is called the statute of limitations. There is no statute of limitations if you commit fraud. And if you never file a return, then there's no limit either, because the statute of limitations doesn't start until you file the return. So if you never filed the return, then there is no statute. So they can go back and look at that year forever. There is no time limit on that. So that is called the statute of limitations. Remember, the 3-year rule is the main rule. 3 years from the date due or filed, whichever is later. But if you omit 25% of your income, it goes to 6 years. If you commit fraud or you don't file a return, then there is no time limit. There are certain instances where instead of filing a Form 1040X, you can instead file a Form 1045, which is an application for tentative refund. So as the name implies, you have to have a refund, and you have to have a refund for a very specific reason in order to file this Form 1045. This can be used by individuals, can also be used by estates and trusts to apply for a quick refund that results from a net operating loss carryback, a general business credit carryback, a Section 1256 contract loss carryback, or an overpayment of tax due to a claim of right adjustment. So if you have any of those, you can use Form 1045, and at least in theory, that should be processed quicker, and you should get your refund quicker than using the Form 1040X. Moving on to our next topic, which is foreign income and accounts. As you will recall, U.S. citizens and resident aliens must report all foreign income, whether earned or unearned. Does not matter. Remember, U.S. citizens, resident aliens are taxed on their worldwide income. So they have to report all of their income, whether it is foreign or whether it is from the United States. Of course, right now we're talking about the foreign income portion. If you live outside of the United States, part of your earned income may be excluded on Form 2555. So we will be taking a look at that. If you paid foreign income taxes, you may get a credit against your U.S. income taxes. We will look more closely at that. And if you had foreign financial assets, such as bank accounts or investment accounts, then you may have extra filing requirements above and beyond the normal income tax return. So let's first talk about the Form 2555. You have heard about Form 2555 multiple times already throughout this course. There are lots of provisions of the tax law where we say either you cannot do this if you file a Form 2555, or if you are looking at your adjusted gross income, you have to use modified adjusted gross income. And often what modified adjusted gross income means is you have to add back any foreign earned income that it was excluded on Form 2555. So let's look more closely at what that means. If you live in a foreign country, you may be able to exclude your earned income up to $126,500 per person in 2024. So, first of all, the main thing to see is it is only for earned income. This does not apply to interest, dividends, capital gains, etc. It only applies to earned income. And the maximum that you can exclude is that $126,500 per person. That's the 2024 number. It does go up each year with inflation. If you exclude your income on Form 2555, even if you exclude all of it, so let's say you earn $110,000 and you exclude the whole $110,000. So you're going to show no earned income on your tax return. You still do have to file a Form 1040. It doesn't matter that you don't meet the normal gross income minimums in order to file. If you exclude your foreign earned income, you still have to file your Form 1040, and then you are going to attach Form 2555 to that 1040. In addition to your earned income, you may also be able to exclude housing reimbursements that you received up to $37,950. If you are self-employed, you may be able to deduct up to $37,950 on your tax return. It is important to note that these rules do not apply to U.S. government employees or to members of the military. In order to qualify for this earned income exclusion or housing exclusion, you do have to qualify by meeting a couple of different tests. First of all, your tax home must be in a foreign country. We'll talk about that. And you must meet one of these two tests, the bona fide residence test or the physical presence test. So there's two rules. Your tax home has to be in a foreign country, and you have to meet one of those two tests. So let's talk about your tax home. Your tax home must be in a foreign country throughout your qualifying period. Usually, your tax home is where you have a permanent or indefinite work assignment as opposed to a temporary one. So if you work for, let's say you work for a US company and they are going to send you overseas to work, and they say, okay, you are now going to be working in Mumbai, India. That is your permanent work assignment from now on. And so that's what you do. You move to Mumbai and you work there. That would then be considered your tax home. Or if they sent you over and they said, we're going to send you over to Mumbai, we're not exactly sure how long you're going to be there. We've got this project we need you to do. You're going to go and you're going to work there until your project is complete. So it's an indefinite period of time. Then that would also count as your tax home. What would not count is if your employer said, hey, we're going to send you to Mumbai to work for 12 months. We're going to send you there to work for 18 months. That would be considered a temporary work assignment because you know it's only going to last those 12 months or those 18 months. So it has to be either a permanent or indefinite work assignment in order for it to be your tax home. If you own your own business, that could also qualify if you go over there and you actually establish a business and you can prove that you established a business, then that could also work as being your tax home. Once you've established that your tax home is in a foreign country, then you have to meet one of those two tests. The first test is the bona fide residence test. For a U.S. citizen, you qualify for this test if you are a bona fide resident of a foreign country for an uninterrupted period that includes an entire tax year, an entire calendar year. That's the first way. So that's if you are a U.S. citizen. If you are a U.S. resident alien who is a citizen of another country and the United States has an income tax treaty with that other country, and you are a bona fide resident of a foreign country or countries for an uninterrupted period that includes the entire tax year or calendar year, then you will also qualify. So notice one important distinction here. The foreign country of which you are a resident does not have to be the foreign country of which you are a citizen. It can be a different foreign country. It's just that in order to qualify, if you're not a U.S. citizen, but instead you're a U.S. resident alien, it has to be that whatever country you are a citizen of has an income tax treaty with the United States. If they do not, then you do not qualify for the bona fide residence test. Whether or not you are a bona fide resident is going to depend on the facts and circumstances of each situation. So they're going to look at things like the nature of your job assignment, whether or not you set up a permanent place to live. So just living in a foreign country for a calendar year does not automatically mean you are a bona fide resident. Just because you were traveling there, maybe you were on vacation, maybe you were working there, but you were just living in a hotel for that entire time. You didn't actually set up a residence. You would not qualify for the bona fide residence test. So the next test, so if you don't qualify for the bona fide residence test, then you want to see, do you qualify for the physical presence test? So for a U.S. citizen or resident alien who is physically present in a foreign country or countries for at least 330 full days during any period of 12 months in a row. This can span over 2 calendar years, and the exclusion then would be prorated between the years. So remember, your tax home still has to be in a foreign country, but you don't necessarily have to be a bona fide resident of a particular country in order to qualify. If you are physically present in any foreign country or multiple foreign countries for at least this 330 days out of 12 consecutive months, then you qualify for the physical presence test. And if you do that, then you will get part of the earned income exclusion in one year and part of the earned income exclusion in the other year if it crosses a calendar year. So in other words, maybe you met this criteria from August 1st of 2024 through July 31st of 2025. Then you would get part of the exclusion for your 2024 tax return and part of the exclusion for your 2025 tax return. Now let's talk about the foreign housing exclusion or deduction. So you have to meet those same rules that we just talked about. So if you are provided a housing allowance by your employer, then you can exclude up to $37,950. That amount can vary. So the IRS does publish lists of countries. Some of the countries have a higher cost of living, so they actually give you a larger amount. But for the exam, the amount you want to remember is this $37,950. And then if you are self employed, you're not getting reimbursed by anybody. So there's nothing to exclude, but you can then deduct up to $37,950 of qualified expenses. And again, that amount could vary depending on which country that you live in. So you have two pieces of this exclusion. You have the earned income exclusion and you have the housing exclusion as well, at least potentially, depending on your arrangement with your employer. You take these exclusions by filing a Form 2555. If you file a Form 2555, you are thereby making an election to exclude those amounts. Once you make that election, it is effective until you revoke it. So if you file a Form 2555 and exclude your income in 2024, then if you have earned income again in 2025, that election is still going to be in effect. And in 2025, you are going to have to again exclude that earned income. If you want to revoke it, you can revoke it. But once you revoke it, you cannot again take the exclusions for 5 years. So you will want to remember that for the exam. If you revoke it, it's revoked for 5 years. Now, you might be asking a question. Why would you not do this? Why would you not exclude your foreign earned income? Well, the reason is there is an alternative to excluding your foreign earned income, and that is to take the foreign tax credit instead, which we will be talking about next. So you could do either. You can exclude your income, or you can take the foreign tax credit for the amount of tax you pay to the foreign country on that income. And then you, of course, as the tax preparer, can run it both ways to see which would be more advantageous. There are other reasons why you might not want to exclude your income. All of those things that we've talked about as we've gone through the course can be affected if you file this Form 2555. So you want to keep those in mind. For instance, you cannot take the additional child tax credit. You cannot take the earned income credit. If you want to contribute to an IRA, remember you have to use your modified adjusted gross income and you have to have a certain amount of earned income, of compensation in order to make an IRA contribution. And you have to add back the foreign earned income when you're computing your adjusted gross income, but you don't get to include that foreign earned income as compensation if you excluded it. So when you look at all these things, you have to look at your own or at your client's own particular circumstances to see, would it be better to exclude it or would it be better instead to take the foreign tax credit? So now let's talk about the foreign tax credit. If you pay income tax to a foreign country, then you get a credit against your US taxes within certain limits. Now, you must actually be liable for the foreign tax. If you could just file a form with that foreign country and get a refund of the amounts that you paid, then that doesn't count. It has to be a tax that you were actually liable for. The foreign tax credit can be used on both earned or unearned income. Remember, the exclusion is only for earned income, but the foreign tax credit you can take on earned or unearned income. And you cannot take the foreign tax credit on any amounts that you excluded on Form 2555. However, if you also had unearned income, or if your income was above the maximum to exclude, and you paid income tax on that excess, you could take the foreign tax credit for those amounts. You report and compute the foreign tax credit on Form 1116. If all of your foreign income is investment type of income, then usually you do not need to file the Form 1116. You can just put the credit directly on your 1040. If you have excess credit, so you got more than you can use, you can carry that back 1 year or carry it forward 10 years. So this is a nice feature. Even if you've already filed last year's return, you can go back and amend and add in foreign tax credit in order to get a refund, or you can carry that forward to future years for up to 10 years. So you will want to remember that for the exam. Foreign tax credit, if you've got extra, can go back 1 year, can go forward 10 years. This last bullet point here, you need to know for the exam. However, in the real world, it's really not relevant. You can, if you would like, instead of taking a credit for the foreign income taxes you paid, you can instead deduct those on Schedule A as a tax. But as we discussed when we talked about credits, a credit is a dollar for dollar reduction in your tax. So it is going to be better than a deduction. But you need to know that you can deduct it because it could be questioned on the exam. Also, remember the foreign tax credit is only for income taxes that you paid. If you have other types of taxes, such as property taxes that you paid in a foreign country, those then you could deduct on Schedule A. You can't get a credit for those property type of taxes, but you can deduct those on Schedule A if you itemize. Foreign retirement income, it's really pretty simple. In general, it's going to be taxed like any other retirement income. The only time it could be different is if there's something in a tax treaty between the United States and the country from which this foreign retirement income was coming that said something different. But in general, foreign retirement income taxed just like U.S. retirement income. Now we're going to switch from foreign income to foreign financial assets. If you have a foreign bank, investment, or other financial asset or account, then you are subject to special reporting requirements. Those requirements could include any of or all three of these listed on your screen. Part 3 of Schedule B, Form 8938, and an F bar. So you might have to do all three of these. You might have to do two of them. You might have to only do one of them. But if you have any foreign financial asset, any type of account, then likely you're going to have to do at least one of these three, and possibly you're going to have to do two or three of them. So let's talk first about Schedule B. You must answer yes and provide the required information on Part 3 of Schedule B if you are required to file Schedule B, which remember that is if you have more than $1,500 of interest and dividends, then you have to file Schedule B. So if you have to file Schedule B and you had a foreign account or received a distribution from or were a grantor of or a transferor to a foreign trust, then you are going to have to mark yes on Part 3 of Schedule B. So what are we talking about? Well, let's look at Schedule B again. You will remember Part 1, you list all your sources of interest. Part 2 is your dividends. Then we get down here to Part 3. So you have to answer these questions. If you are filing Schedule B, even if you don't have any foreign accounts, you still have to answer these questions. But if you don't have any foreign accounts, of course, you would just say no. But we're talking about here if you do have foreign accounts. So it asks, at any time during 2024, did you have a financial interest in or signature authority over a financial account located in a foreign country? And then you have to say, yes, I did. Then it says, if yes, are you required to file FinCEN Form 114? That's the F bar. And so you have to answer either yes or no. If you answer yes to that, then you have to list here the names of the foreign countries where you had any financial accounts. Then the last question is, during 2024, did you receive a distribution from or were you a grantor of or transferor to a foreign trust? And then you are going to click yes there. And it reminds you that if you say yes, you may have to file this Form 3520. that we will look at here in a few minutes. So, your next possible reporting, if you have foreign financial assets, is Form 8938. You have to file this form with your tax return if the total value of your foreign bank and financial accounts and other foreign financial assets reaches a certain threshold. The amount of the threshold depends on whether you are living in the United States or not living in the United States, and it depends on your filing status. If you are living in the United States, but you've got a foreign account, if you are unmarried or married filing separately, if the total value of your foreign accounts is greater than or equal to $50,000 at the end of the year, December 31st, or greater than or equal to $75,000 at any time during the year, even if it was only for one day, then you must file a Form 8938. If you are married filing jointly, those numbers double. If you are living outside of the United States, the thresholds are higher. They're giving you more leeway. I think they're assuming that if you live outside the United States, you're more likely to have foreign financial accounts. So they're making the threshold higher. Here, if you're unmarried or married filing separately, then if that account or the total of your accounts are valued at $200,000 or more at the end of the year, or $300,000 at any time during the year, then you have to file the form. And of course, those amounts double if you are married filing jointly. Then our third possible reporting that you will have to do is the FBAR. So it is the Report of Foreign Bank and Financial Accounts, commonly called the FBAR. It is also called FinCEN Form 114. That's the Financial Crimes Enforcement Network Form 114. Same thing. You do have to file the FBAR if you're required to file it, even if you filed Form 8938. So it's not like you file one or the other. 8938 is an IRS form that you file with your tax return. The FBAR is not an IRS form. You do not file it with your tax return. So they are two different things. The FBAR needs to be filed by a U.S. person, which includes a citizen, a resident, a corporation, a partnership, a limited liability company, a trust, an estate, if they have a financial interest in, or signature or other authority over, at least one financial account located outside the United States, if the aggregate value of all of those foreign accounts exceeded $10,000 at any time during the calendar year. Again, even if only for one day, you add up the value of all your foreign financial accounts. If that value is more than $10,000 at any point, then you must file an FBAR. The FBAR is due on April 15th, but remember, it is not an IRS form. You can get an automatic extension to October 15th. You file this form electronically. You cannot file it on paper. You file it electronically through FinCEN's system, and the penalty for not filing it is $16,117. If you were willfully not filing it, the penalty could be substantially more. So if you're trying to hide your assets from the IRS, you're doing it on purpose, you're not filing this form, then the penalty can be a lot greater. But if you just overlook it, you're not familiar with it, you didn't know you had to file it, you forgot about it, etc., $16,117 penalty for failure to file. If you are interested in court cases, tax-related court cases, there was actually a Supreme Court, United States Supreme Court case that came out recently that had to do with this. This penalty, the $16,117, used to be $10,000. It's now gone up. They're going to be raising it now with inflation. But it used to be $10,000 if you did not file your FBAR. So what happened with the Supreme Court case was there was a gentleman who did not file it for 5 years, and it was not willful. The government agreed it was not done willfully. He just overlooked it, did not file his FBAR for 5 years. So he said, okay, I didn't file it. It was a $10,000 penalty. 5 years, that is $50,000. So he had a penalty of $50,000. The IRS did not agree. The IRS said, no, 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 it's not $10,000 per year. It's $10,000 per account per year. And this guy had, I believe it was dozens of foreign accounts. Now you list them all on one FBAR, but obviously you got multiple lines. You have to list every account. So the IRS said $10,000 for that account, $10,000 for that one, so on and so forth. For 5 years, it added up to, I think it was more than $2 million in penalties that the government assessed. And so this went all the way through the courts. And there had been a different court in the United States. So the United States is broken down into different circuits, and they're all kind of independent. And so a different circuit court had a similar case, and they had sided with the taxpayer and said, no, it's just $10,000 per year. But our unfortunate taxpayer had a different circuit court, and that circuit court agreed with the IRS. And they said, nope, it is $10,000 per account. You owe millions of dollars worth of penalties. So the U.S. Supreme Court agreed to hear this case in order to resolve this discrepancy between these circuit courts. And so what they finally found was they found in favor of the taxpayer, and they said, no, it is just $10,000 per FBAR. So it's $10,000 per year, not $10,000 per account. So he saved millions of dollars by going through this process. Of course, he had to pay attorneys and court costs, and it took a lot of time. I'm sure it was very stressful, but he saved himself those penalties, and he saved a lot of future taxpayers who might be in a similar position a lot of penalties as well. And now, of course, that $10,000 penalty is $16,117. That's the amount you will want to know for the exam. Form 3520. So this is that form that was mentioned on Schedule B that said if you had any interaction with a trust, then you may have to fill out this Form 3520. The IRS is very leery of foreign trusts because a lot of tax scammers will try to use them to evade U.S. income tax. So they want to know if you have a foreign trust. So if so, then you have to fill out this Form 3520 and submit it with your tax return. Also, there's another form, a Form 5471, that certain people who own foreign corporations have to report. So this is for U.S. officers, directors, and or shareholders of certain foreign corporations. You have to file this Form 5471 to let the IRS know about it. And if you want more information, you can see the form instruction for details. Our next topic is household employees. If you have a household employee, you may need to withhold and pay Social Security and Medicare taxes and pay FUTA, which is federal unemployment tax, or both. You do not need to withhold federal income tax from your household employee's wages. However, if that employee asks you to withhold federal income tax, you can if you want to. And there is a whole publication 926, that discusses all of the rules that we are about to talk about. So here are some examples of who might be a household employee. You can see there in the list, babysitters, butlers, caretakers, housekeepers, etc. When do you have a household employee? You have a household employee if you hired someone to do household work and that worker is your employee. That worker is your employee if you can control not only what work is done, but how it is done. If the worker is your employee, it doesn't matter whether they're full-time or part-time. Doesn't matter how you came to hire them. It doesn't matter if you pay them by the hour or the day or the job. If they are your employee, they are your employee, and you have to follow these rules. Sometimes it is helpful to understand what is an employee by understanding what is not an employee. So, if only the worker can control how the work is done, then the worker is not your employee, but instead they are self employed. A self employed worker usually provides their own tools and offers services to the general public in an independent business. If an agency provides the worker and controls what work is done and how it is done, then that worker is not your employee. So let's look at a couple of examples. Let's say you hire somebody to come over and cut your grass and do your landscaping. They come over, they use all their own lawnmowers and all their own tools, and then they move on to the next job because they're not just working for you, they're doing work for all kinds of different people in the community. They are an independent business. That is not an employee. You do not have to worry about any of this. Contrast that, though, with, let's say you have an elderly person. They're no longer able to care for their property. They may have a good sized piece of property with several buildings, and they just can't take care of it anymore. So they may hire a caretaker, and that caretaker comes and they work full time. They may even live on premises. They may live in a room in the house, or they may live in a separate building on the premises, and they're taking care of all the work. They are using the homeowner's tools and lawnmowers and what have you. That person sounds a lot like an employee. Even if they occasionally do work for the neighbors or for somebody else on the side, still their full-time job is working as a caretaker. So that person likely is an employee. Or maybe you've got a nanny. So if you've got a full-time nanny, they come to your house Monday through Friday, 7:30 a.m. to 5:30 p.m. They work for you full time. Maybe they babysit for other people occasionally on nights and weekends, but basically their job is working for you. Well, then they are an employee. However, if they work for an agency, so there are a lot of agencies out there who will provide nannies and other type of caretakers. Well, if the agency is controlling when they work and is paying them, and then sometimes if that person can't show up, the agency sends a substitute to work for the day. Well, in that case, they are not your employee. They are an employee of the agency. The agency will pay them, give them a W-2, etc. But if you do have a household employee, then you may need to issue them a W-2. You have to issue a W-2 for a household employee if you paid them $2,700 or more for the year, or you withheld federal income tax. So remember, you don't have to withhold federal income tax, but if you choose to, then even if you pay them less than $2,700, then you still have to issue a W-2. If you issue a W-2, you have to do so by January 31st of the following year. The employee gets copies B, C, and 2. The government gets copy A along with a transmittal form, and that form is a Form W-3. And then you have to remember you may also have to report to a state taxing authority. And the W-2 is for information only. You don't send any money along with the W-2, even the one you send to the government. There's no money that goes. It's just an information return. So the employee knows how much they made, and the IRS knows how much that person made. If you do file W-2s, then you are going to need to get an EIN, which is an employer identification number. This is very easy to do. You can do it online in about 10 or 15 minutes. It is completely free at irs.gov, but you do have to get an EIN if you are filing any W-2s. And there's a few reasons for this. First of all, because they tell you that it's required. Secondly, because the only alternative you have is when you file the W-2 is to use your social security number. And of course, with all the identity theft out there, you do not want your employees knowing your social security number. And also, your employees don't want you to use your social security number, because if you do, they now have a W-2 with a social security number instead of an EIN. If they try to file their tax return electronically, that return will be rejected. The IRS will not accept their tax return if their W-2 has a social security number instead of an EIN. So if you have a client who has household employees, issues a W-2, help them to get an EIN. Very simple to do. Schedule H. Schedule H is how you are going to compute and show and pay the amount of taxes that you owe for your household employee. Schedule H is attached to your Form 1040. If you're not required to file a 1040, then it can actually be filed separately. But generally, most people are going to be filing the 1040, so you just attach Schedule H to it. This is used to compute and pay all of your employment taxes, so Social Security, Medicare, federal unemployment tax, and any income tax that you did withhold from those household employees. You are required to file a Schedule H if you are required to file a W-2. So it's the same exact rules if you paid $2,700 or more, or if you withheld federal income tax. So if you were required to file a Form W-2, then you are also going to be required to complete Schedule H. Also, even if you didn't have to file a W-2, if you paid wages of $1,000 or more in any one quarter to any one employee, then you have to file Schedule H and pay that FUTA tax. So, for example, let's say you paid one employee $1,500 in one quarter. Do you have to file? Yes, you have to file a Schedule H because it is greater than $1,000. You have to pay the unemployment tax. Now, you do not have to pay, if that's all you paid during the year was $1,500 in one quarter, you do not have to issue them a W-2. You do not have to pay Medicare and Social Security tax, but you do still have to file the Schedule H and pay the federal unemployment tax. And then you also want to remember that there could be state unemployment tax due as well as state income tax withholding. That's a reminder. Of course, that's not going to be tested on the EA exam. When you pay this tax, if you remember back when we talked about other taxes, these taxes were one of the other taxes. So you use Schedule H, you compute everything that you owe, and then whatever amount you owe, you list as an other tax on the 1040. If you're not filing a 1040, then you just send in the amount with your Schedule H. So here is a nice recap of the rules and actually a little bit more details about the rules. This is from publication 926, and you have it, of course, in the slides as well. So this is going to remind you, if you pay wages of $2,700 or more to any one household employee, then you're going to have to withhold and pay Social Security and Medicare taxes. Now, notice there are some exceptions to the paying $2,700. If you are paying your spouse the money, you do not have to pay these taxes. If you are paying your child who is under age 21, you don't have to pay these taxes. If you are paying your parent, then you don't have to. And if you are paying any employee under the age of 18, then you do not have to pay Social Security and Medicare taxes on them. But if you are paying anyone else $2,700 or more, then you have to pay the taxes. The Social Security and Medicare taxes are 15.3% of wages. Half of that is from the employer, 7.65%. Half is from the employee, 7.65%. You can withhold that amount from your employee, the 7.65%, but you don't have to. If you want to, you can just pay it yourself. So you can just pay the whole 15.3% yourself. Otherwise, you withhold 7.65% from the employee, and then you have to pay out of your own money the other 7.65%. In addition to that requirement, if you pay total cash wages of $1,000 or more in any calendar quarter, then you're going to have to pay that federal unemployment tax. So you can see you've got some exceptions here too. You don't have to do it if it's your spouse. You don't have to do it if it's your child under age 21 or if it is your parent. But if it is any other person under age 18, you do still have to pay the federal unemployment tax. The federal unemployment tax is 6% of wages up to $7,000 maximum of wages. So in other words, the maximum federal unemployment tax is $420, $7,000 times 6%. Our next topic is marriage and divorce. First thing we want to talk about is injured spouse and innocent spouse. One important thing to know is that these are two separate things. So sometimes people get them confused or they think they're the same thing, and they are not. They are actually very different things. We're going to talk about each of them, but injured spouse, innocent spouse. Let's talk first about injured spouse. So, in general, the IRS is going to offset any current refund to pay any past due tax debts. So, if you owe money from a previous year for your taxes, and then you file this year's tax return and it shows a refund, the IRS is not going to send you that refund. They are going to use that money to pay the past due taxes that you owe. Now, if your refund is greater than the amount that you owe, then they will send you the difference. But they are going to offset any past due taxes against the refund that you are due. This can raise problems when you are filing jointly and only one spouse owes the IRS. This can happen a lot when people first get married. So they first get married, one spouse owes the IRS from a previous tax return, of course, when they were single. And now they're filing a joint return and they are getting a refund. So, what the injured spouse can do is they can say, hey, look, they can fill out this form 8379, and that lets them tell the IRS, don't offset this amount because the taxes due are from my new spouse. They're not for me. So, you need to send me the amount of my refund, and then the IRS will do that. You can also file this form after the fact. So, sometimes people get married and they don't know that their new spouse had a past tax debt, or they don't realize that the IRS is going to offset their refund in order to pay that tax debt. So after they find out, then they can file a Form 8379 in order to get their refund. And then the bottom here, we just have a reminder that this is different than an innocent spouse. So let's talk about that innocent spouse. What the innocent spouse does, we call it innocent spouse relief. It gives you relief from joint responsibility on a married filing jointly return. Remember, when we talked about filing statuses, we said that if you are filing married filing jointly, both parties are jointly and severally liable for the amount of the tax. So the IRS can go after both of them and each of them separately in order to collect any tax that is due. But sometimes you've got one spouse who is doing something improper or illegal, so either intentionally or unintentionally, they're doing something wrong, and the other spouse is genuinely not aware of it and they're not involved with it. So this lets that other spouse say, hey, don't come after me for this. This is all on the other person. They can do this by filing a Form 8857. Now, this is not automatic. The IRS will look at the facts and circumstances to determine whether or not the person actually is an innocent spouse. So, let me give you an example. If you are a tax nerd like me and you like reading tax cases, there are actually a lot of interesting innocent spouse tax cases because it's usually happening with very wealthy people. And so they live very extravagant lifestyles. And so you can read about all of this in these cases, and then you can read how the courts ruled. But I want to give you an example where someone who is quote unquote innocent may not be actually considered to be innocent. I'm going to give you an intentionally exaggerated hypothetical example in order to make the point. Let's say you have a husband and wife, and most of these tax cases that you read are older cases, so it's usually the wife that is filing for innocent spouse relief. Of course, it does not have to be at all that way, but in these cases, that's the way it typically is. So, for our example, we're going to use the wife here. So, let's say you've got a husband and wife. The husband owns a business, runs the business. Wife has absolutely nothing to do with the business, knows nothing about what is going on with the business. Gets to the end of the year, husband comes home, fills out the tax return. It shows $40,000 of income from this business. Husband and wife both sign, and file the tax return. IRS comes back, does an audit, says, nope, not $40,000 of income, but $400,000 of income from this business. And it wasn't just this one year that the income was underreported. We went back several years. Remember, if you omit 25% or more of your income, they can go back 6 years. If you commit fraud, which a case like this could potentially be fraud, there is no statute of limitations. They can go back to the end of time in order to go after your tax returns. So let's say the IRS goes back several years, finds out they've been underreporting their income for all of those years, and they, of course, assess a large amount of tax due, along with a large amount of penalties, along with a large amount of interest. This could be a huge tax bill in some of these cases. So, in our hypothetical example, then our wife, who's not involved, goes and seeks help from a tax professional, and they file for innocent spouse relief. And they say, hey, look, I don't know anything about the business. I don't work in the business, not mine. I had no idea this was going on. So don't come after me, go after my husband. Well, it might sound on the surface like that's a slam dunk case of innocent spouse. She didn't work in the business, she didn't know about it. But let's give you a few more details, a few more facts to go along with this. Let's say this couple lives in a huge home in the nicest part of town in a gated community. They drive very expensive cars. The husband gives the wife many expensive gifts, lots of expensive jewelry and other types of gifts, gives these gifts frequently. They go on all kinds of extravagant vacations. They go on cruises. They go on European vacations. They go on African safaris. They are living the life. In that case, the IRS is going to step in and say, no, you are not an innocent spouse. Yes, we agree. You weren't involved in the business. You didn't technically, quote unquote, know what was going on. But it's common sense when your husband comes home and says, hey, we make $40,000 a year in our business, that there's no way you are living the lifestyle you live on $40,000 a year. So you're actually not so innocent. You were just putting your head in the sand and pretending like, oh, I don't know anything, but you actually did know. So you are not going to get innocent spouse relief. And in that case, the courts would, of course, agree with that. And again, that's a kind of ridiculous, over the top case, but that gives you an idea of why someone might not be considered an innocent spouse, even if they really had nothing to do with whatever the issue was. And then, of course, a lot of these end up going to court because the IRS and the taxpayer can't agree. So that is innocent spouse. You can find out more about that in this publication. 971 tells you when you qualify, how to apply, what the procedures are, etc., and so forth. Community property states. So you will want to know for the exam, there are certain states that are community property states. And if they are, then any earned income is generally going to be considered owned 50-50 by the spouses. So if they are married filing separately, each spouse will claim 1/2 of all the earned income and all of the withholding. So you would add both spouses together. It doesn't matter if they both work or just one works. It doesn't matter. You add the total amount of earned income, the total amount of withholding, and each spouse gets half of that if they are married filing separately. However, IRA distributions are going to be taxable only to the spouse that is named on the account. For more information, you can see publication 555. But we will show you a list of the community property states, just in case maybe you live in one and you were not aware of it. These are the community property states. You don't have to know these for the exam. If they have a question, then they will usually tell you that it is a community property state. You can note that California is one. A lot of times you'll hear these cases about celebrities and this issue comes up, but these are all of the states. And then there are a few states, Alaska, Tennessee, and South Dakota, that kind of have a hybrid type of system. And so if you've got issues there, then you will need to look up the specifics of that. But for the exam, you want to know what was on the previous slide about splitting the earned income. Now let's talk about divorce. We've actually talked about many of these topics as we've gone through, so we're just going to do a quick reminder and talk about a couple of things that are a little bit new. We're going to talk about alimony, child support, and property transfers. Alimony, as you will recall, we did talk about this a couple of times. If you have a divorce after 2018, so 2019 or later, then any alimony is not deductible by the one who paid it. It is not included in the income of the one who receives it. The same rule applies even if you had a pre 2019 divorce. If they did a modification of that divorce later, and they expressly state in that modification that the payments will not be deductible and not be included in taxable income, then you would follow that modified agreement and you would treat it just as if it were a post 2018 divorce. If you have a pre 2019 divorce or 2018 or sooner, then the alimony is deductible by the one who paid it. It is included in the income of the one who received it. And that is true for as long as the payments are made. So it doesn't matter that some of the payments were made in 2019 or later, as long as the divorce itself was from 2018 or earlier, then these are the rules that apply. Child support, of course, is never deductible for the payer, never included in the income of the recipient. I think we've gone over that enough times. Property transfers. You may remember we said property transfers incident to divorce do not result in gain or loss. So, what does it mean, incident to divorce? A transfer will be considered incident to divorce if it is either made within 1 year of the date of the divorce or made under an original or modified divorce agreement within 6 years after the divorce. So any transfer of property between spouses or former spouses within 1 year after the date of divorce will be considered incident to divorce, even if it's not provided for in any kind of agreement. If there is an agreement that calls for a transfer of property, as long as that transfer occurs within 6 years after the divorce, then it too will be considered a transfer incident to divorce. So remember that rule. Mostly remember property transfers incident to divorce are not taxable, do not result in any kind of gain or loss. And then you can also remember what incident to divorce means. There are special rules for retirement plans. And here we're specifically talking about work related retirement plans like 401k, 403b. Sometimes in a divorce, the non employee spouse will be awarded part or all of the retirement account of the spouse who is the employee. In other words, you got one person, they're at work, they're contributing to their 401k plan, so it is their 401k plan. But sometimes in the divorce, their spouse will get all or part of that plan. When that happens, the judge in the divorce case will issue something called a qualified domestic relations order, pronounced quadro. So they will send that to the plan administrator. The plan administrator will then issue a check to the non-employee spouse. When they do that, those distributions are taxable, assuming it's coming from a traditional plan, not a Roth plan. Those distributions are taxable to the receiving spouse, but they do not have to worry about that 10% penalty for early withdrawal. And they can avoid tax altogether if they roll that amount over into an IRA or into a different qualified retirement plan. So that's the way it works with a quadro. If you have an IRA, there is no quadro required. You could still split those accounts, or one person's account could be awarded to the other spouse. But in that case, that is a transfer incident to divorce. And of course, that is not a taxable event, and you don't need any kind of court order. Our next topic is estate and gift tax. Both estate and gift tax deal with the tax effects of giving away or transferring assets. Gifts are transfers before death, and for an estate, it is after death. And in either case, whether it's a gift or whether it is an inheritance, Strictly speaking, the recipient does not pay any income tax on the transfer itself. So if you receive $100,000 from a bank account from your parents who died, that is not taxable. You do not have any tax on that. But there could be income tax consequences to owning the asset. So, for instance, if it is stocks, then you could have tax consequences. Or if it is a retirement plan, there could be separate tax consequences. But there's no income tax just from receiving the inheritance itself. Gifts and transfers on death above certain thresholds may be subject to a different kind of tax called the gift and estate tax. This is not an income tax, it's separate, but it is possible that the one giving the gift or the estate could have to pay this gift or estate tax. But again, it is the one making the gift who pays this tax. It is not the one who receives the gift. The one who is receiving the gift does not have to worry about any kind of taxes. It is only the estate or the person giving the gift. Not all gifts or estates are going to be taxable. Everyone gets a lifetime combined gift and estate exemption amount. If you give amounts under this exemption amount, then you do not have to worry about the gift or estate tax. The amount of the exemption is going to depend on your year of death. For 2024, that exemption amount is $13,610,000. What that means is if you give away either before or after death less than $13,610,000, you do not have to worry about any gift or estate tax, which of course means the vast majority of Americans will never have to worry about gift or estate tax. This is only going to apply to wealthy individuals who have a lot of assets. Also, that $13,610,000 can potentially double. So if you are married, one spouse dies, all of their assets can then transfer to the living spouse tax-free, and that surviving spouse now gets double the normal exemption. They get their own exemption, plus they get their deceased spouse's exemption. So that totals $27,220,000. So now let's talk about the gift tax. In addition to that lifetime exemption of $13 million, there's also an annual exclusion amount. So if you give a gift underneath the exclusion amount, then you don't have to pay gift tax and you don't have to worry about reducing that $13 million exemption. It has no effect whatsoever. The exclusion amount for 2024 is $18,000. So this means you can give someone up to $18,000 without reporting it and without counting it against your lifetime exemption. There's also something called gift splitting. So this is if you are married. You and your spouse can each give $18,000. So for example, a married couple could give their child $36,000 without affecting the lifetime exemption. And it doesn't matter whose account it comes from. So maybe the husband and wife have separate accounts and the whole $36,000 comes from the wife's account and goes to the child. Doesn't matter. They are married. So you can just say, nope, $18,000 of that was from the husband, $18,000 of that was from the wife. And so that is called gift splitting. And then you don't have to worry about paying gift tax. And it doesn't affect the lifetime exemption. And then also, if the child that they are giving the gift to, if that child is married, then each parent can give both the child and the spouse $18,000. So they can give the child $18,000 each, which is $36,000, and they can give the child's spouse $18,000 each, which is another $36,000. So they can actually give $72,000 to their married child and their spouse without gift tax and without affecting the lifetime exemption. There are also some exceptions. So even if you give more than the $18,000 to someone, it is not reportable. It does not count against your lifetime exemption. if the gift was for educational expenses. So it has to be tuition paid directly to the school. So, for example, parents might be paying their children's college tuition, or grandparents might be paying their college tuition. So, as long as they are paying it, it's only for tuitions, not room and board or anything else. But if they're paying that tuition directly to the school, then that is not considered a gift. You don't have to report it, you don't have to worry about it. Also, if it was for medical expenses that were paid directly to the care provider. So, again, the person had a bunch of medical expenses, they had a hospital stay. If, say, the parent or the grandparent steps in, pays those payments on the child's behalf, pays them directly to the hospital or to the doctor, etc., then that is not considered a gift. Of course, that is only for amounts that are not covered by insurance. Also, any gift to a spouse who is a United States citizen, you don't have to worry about that. So spouses can give money or gifts back and forth all the time as long as they are both US citizens. No problem. You don't have to report it. There's no $18,000 limit. You can just pretend like it did not happen. If your spouse is not a US citizen, we'll talk about what happens then here in a couple of slides. If you make a political contribution, that is not a gift. You don't have to report it. If you make a qualified charitable donation, that is not a gift. You don't have to report it. If you do give someone more than $18,000 in a year and you don't meet any of the exceptions, then you have to file a gift tax return. You do this on Form 709. The return is due on April 15th. However, it is separate from the 1040. So you don't attach it to the 1040. You send it in by itself. And spouses may not file a joint gift tax return. They have to file their own 709s, and they have to do so to show split gifts. So remember, we said they could give $36,000 to a child, and if the child's married, to their spouse without any effect. And that is true. However, since they are technically giving more than $18,000, they do have to file a Form 709 in order to show that they did split that gift. So it would just be for information only. There wouldn't be any tax due, but they would have to file the 709. For those gifts in excess of $18,000, you have a choice. You can either pay the gift tax, or you can apply the excess against your lifetime exemption. So you've got that 13 plus million dollar exemption. So this is what most people do. They just say, okay, I gave a gift of $30,000. That's $12,000 more than the $18,000 exclusion amount. So they will say, okay, I am applying $12,000 against my $13,610,000 exemption. So you just put that on the form. There's no tax due, and you're just now going to keep track of that. So anytime you give a taxable gift, you're just going to have to keep track of how much exemption that you have left. Alternatively, you can pay the tax. The gift tax ranges from 18 to 40%. You will want to know those percentages. You don't have to know exactly what the brackets are, but just know that the range is from 18 to 40%. Also, you have to realize what is a gift. So gifts can be pretty simple. They can be in cash, they can be in property, but they could also be in debt forgiveness. You may not think of that as a gift, but if you forgive a personal debt, then that can be considered a gift, and you have to fill out a gift tax return in order to report that. Also, if you do a below market sale of property, it can be a gift. So let's say you own a house that's worth $300,000 and you're going to give that to your child and you're going to sell it to them for $100,000. Well, you have just made a $200,000 gift to that child. Even though it doesn't look like a gift, it looks like they're buying the house. The fact is they're buying it at a bargain price, and the difference between the fair market value and what they actually paid for it is considered a gift. So you would need to report that on a 709. So now let's talk about that gift to a non-citizen spouse. So as you will recall, gifts to a spouse who is a U.S. citizen are fully excluded don't have to be reported, don't have to worry about it. If the spouse is a non citizen, so it doesn't matter if they're a resident alien, a non resident alien, a dual status alien, then only the first $185,000 per year is excluded. So instead of an $18,000 exclusion, you have a $185,000 exclusion. Any amounts in excess of the $185,000 would be reported on the 709, and you either pay the gift tax or you reduce the lifetime exemption. So that's how that works if your spouse is a non US citizen and you are giving them gifts. Now let's talk about the estate tax. At death, the decedent's gross estate consists of virtually all of their assets. In part 2 of this course, we are going to talk about estate tax returns. So we'll go much more into this at that time. But for now, you just need to understand the basic idea here. All of their assets are considered part of their estate. That's their gross estate. You do then get to deduct certain things: funeral expenses, administrative expenses, attorney fees, and there are certain adjustments that you are allowed as well. So you subtract those expenses and those adjustments from the gross estate. That leaves you with the taxable estate. You then compare that to the remaining lifetime exemption. So they had their lifetime exemption, $13,610,000. You subtract any gifts that were used to reduce that exemption. You say, okay, what's my remaining exemption? To the extent that your estate exceeds the remaining exemption, then you're going to be subject to the estate tax. So again, what this means is the vast majority of people are not going to owe any estate tax. They're not going to have to fill out an estate tax return. This is only going to be affecting those very wealthy individuals. But let's talk about that estate tax return. For the estate tax, you use Form 706. You may recall the gift tax return is a 709. So this can get confusing because the 6 is just an upside down 9. So it's like, well, which one is which? Which is the gift and which is the estate? So I'm going to give you an easy way to remember it. A gift is given while you are alive. So while you are above ground. So the little loop on the 9 is on top. It's above ground. That's a gift tax return. The 706 is filled out after you are dead, when you are below ground. So the little loop on the 6 is down. It's down below ground. So that is an estate tax return. I apologize if that sounds crass or insensitive, but it is an easy way to remember which return is which. So for the estate, we use a Form 706. You have to file it, as we said, if the taxable estate exceeds the lifetime exemption. You also have to file it in order to elect the portability for the surviving spouse. So remember, we said you get your $13,610,000 exemption, and if your spouse dies, then you can double that. In order to claim that extra exemption, you have to file a Form 706 when the first spouse dies, showing that that exemption is then moving over to the surviving spouse. The 706 is due 9 months after the date of death, though it can be extended by an extra 6 months. And the estate tax ranges from 18% to 40% because it is a gift and estate tax. It's all one system, so it is the same range of tax rates. And so again, you'll remember that 18 to 40%. The generation skipping transfer tax, or GST. So estate and gift taxes are meant to tax transfers of assets as they pass from one generation to the next. So an asset that's owned by a grandparent would be taxed when it's passed to their child. And then when their child passes it on to their child, so to the grandchild of the first person, then it would be taxed again. So to get from grandpa to grandchild, there would be 2 levels of tax. Some wealthy people used to skip one of those levels by just bequeathing the assets straight to the grandchild. So they could just skip the tax that should have been imposed when it went to their child first. So the generation skipping transfer tax closes that loophole by imposing a 40% tax on any such transfer. Now, of course, this only applies to people with assets in excess of the lifetime exemption. Under the lifetime exemption, you don't have to worry about the GST. And also, though, it does disregard any spousal portability election. So if the one spouse gets the double exemption, they don't get to count the double exemption for purposes of the GST. Estate planning. You do not have to be anywhere close to an estate planning expert in order to pass the EA exam. We're just going to mention these things so that you are at least familiar with them. You've heard them before. So if something comes up, you have a basic understanding of it. So we're going to talk about each of these things. Trusts. There are many different kinds of trusts. One basic way to break them down is between being revocable and irrevocable or irrevocable, however you want to pronounce it. So, a revocable trust is sometimes called a living trust. You may be familiar with this. You set up a trust, you have to go to a lawyer and you get it all written up. And then you put your significant assets into the name of the trust. So you put your house in the name of the trust. You put your bank accounts in the name of the trust. You make the trust the beneficiary on your retirement plans, maybe even on your life insurance, et cetera, and so forth. Then when you die, all of the assets are owned by the trust. And what that does is it avoids probate. So probate happens in the courts. It is very public. So if your assets go through probate, anybody can look and see what assets you left and who you left them to. If you have your assets in this trust, it does not go through that process. And so it's all kept private. And then you can specify in the trust who is going to get what. An irrevocable trust can be used to move assets out of your estate, to protect them from creditors, and to transfer them to specific beneficiaries. So when you put assets into an irrevocable trust, you cannot bring them back out. A revocable trust, as the name implies, is you can revoke it at any time. You can put assets in, take assets out, doesn't matter. You can do that anytime as long as you are alive. With an irrevocable trust, you cannot. Once you put the assets in there, they have to stay in there. One of the benefits of that is it gets it out of your estate. So when you're talking about that exemption, the 13,610,000, any amounts in an irrevocable trust are not included in your estate. So that is really the big benefit that wealthy people will use these for. It also protects them from creditors because now the trust owns the asset rather than the individual. And of course, just like any other trust, it allows you to leave assets to whomever you want to leave them to. And there are lots of other types of trusts, lots of different types of irrevocable trusts that can do different things. We will talk more about trusts in part 2, but now you just want to understand basically the idea of how they work. And we will talk about a couple of different kinds of trusts here as we go on in this video. Family partnerships or family limited partnerships. These are controversial. The IRS scrutinizes these very closely, but they can still be done and they can still be very effective. So what you do is you use a family limited partnership to own a business. So let's say you've got the patriarch of the family, started this business, it's very successful, owns this business. What they can do is they can transfer that business into a partnership. Sometimes they first transfer it into a trust and then they make the trust the partner in the partnership. But in any case, you form this partnership with various family members being partners or trusts for their benefit being partners. So these can get very complicated. But once you transfer that business into the partnership, its value is automatically reduced. And this goes into valuation theory, which again, you do not need to know for the exam, but there are certain discounts that you get when you are valuing a business or any asset. One of those is called lack of control. Another one is called lack of marketability. So because of these discounts, the business is not worth as much as it would be if the patriarch of the family still just owned it himself. So what this does is it helps lower the value of that person's estate and to lower gift and estate taxes. After you've formed this partnership, there can now be partnership units that can be gifted. So you can start to transfer the business from one generation to the next by giving gifts. Remember, we talked about these split gifts. You can give $18,000 a year to somebody with no gift tax consequences. If you're married, you can give $36,000. If the person you're giving to is married, you can give $72,000. So what families will do is they will start making gifts each year of partnership units that are worth $18,000 or $36,000 or $72,000. So they will gift enough to not have to pay any gift tax. And that $18,000, by the way, that's the 2024 number that goes up each year with inflation. So they'll just every year they will give gifts that fall underneath that exclusion amount, thereby avoiding the gift tax. So over the years, they can transfer the entire business to the next generation with no gift or estate taxes. So what are the downsides of this? Well, first of all, we already said the IRS is very leery of these. They are likely to audit these and to scrutinize them very closely. So that's the first thing. Also, they are very expensive to set up and maintain. You have got to have attorneys, you've got to have accountants, and you're going to need them every year because you're going to have tax returns for the partnership. If they've got a lot of trusts that they have formed, which they often do, they often form trusts along with the partnership. Now all the trusts are going to have tax returns. And then you've got the individuals, and now their tax returns are even more complicated because they've got partnership and trust issues to deal with. So it's very complicated, very expensive. Also, you do have to have at least one general partner who can be exposed to liability from the business, as opposed to, for instance, if it was a corporation. We'll talk more all about that in part 2. And then finally, you do have to have a valid business purpose. So when the IRS comes and looks at this, if you just did this just to avoid taxes, they will just act like it never happened. They will ignore it, and they will tax everybody as if this family partnership did not exist. So again, very complicated, very expensive. This is not something you are going to do on your own. This is not something I would ever try to do on my own. This is something you would refer them to an attorney who understands all this and who's experienced in this in order to set this up. Charitable giving. Charitable giving is a way to get assets out of your estate and therefore to save estate taxes. And you can also avoid capital gains tax on any appreciated assets. Another thing you can do is you can set up something called a donor advised fund. So this is a charitable fund that's maintained by a public charity. So public charities will set these up for individuals and families because they know that they are likely to be getting some contributions from this. So what you do is you contribute to the fund, you get a tax deduction for that on your Schedule A itemized deductions, and you can make continuing deductible contributions, and you also get to advise which charities the fund should support. So you've got some control over saying, okay, I'm giving to this fund, I would like the fund to support A, B, and C charities, and it will do that. Also, other family members can donate to this. It can become kind of a family legacy. It gets passed down generation to generation. You keep the fund going, you keep funding it, you keep funding your favorite charities, and it can be a great thing to do over time. Another thing you can do that we've talked about before is this qualified charitable distribution from an IRA. Again, it gets it out of your estate. You can do this up to $105,000 per year. And of course, you don't have to pay tax on the distribution from the IRA. There are a couple of different charitable trusts that you can use. The first is called a charitable remainder trust. So these are both irrevocable trusts. So with the charitable remainder trust, you donate assets to the trust, but the income from those assets comes back to you as long as you are alive. So let's say it's stocks, and the stocks pay dividends. So you put the stocks into the trust. It's irrevocable, so you cannot get them back out. But you put the stocks in there, but now the stocks pay dividends. So the terms of the trust will say that those dividends will come back to you during your lifetime. So you get to use those dividends to pay your expenses, et cetera, and so forth. And then when you die, the remainder, in other words, the stocks go to the charities of your choosing. So you get the income while you're alive. Charity gets the stocks after you die. In this case, the trust itself does not pay any tax on the earnings. You do. The dividends are coming to you. So you'll get a K1 from the trust that reports all these dividends, and then you put those on your 1040 each year. So the trust doesn't pay the tax, you pay the tax. The next type of trust is a charitable lead trust, and this is kind of the opposite of the other one. With a charitable lead trust, you donate the assets to the trust. So let's say it's stocks again, but in this case, it's the opposite. While you are alive, the income, the dividends from the stocks, that goes to the charity. The charity gets the income from the stocks while you are alive. And then after you die, the stocks do not go to the charity, the stocks go to your beneficiaries. So with the charitable remainder trust, you get the income, and when you die, the charity gets the stocks. With the charitable lead trust, the charity gets the income, and when you die, the stocks go to your beneficiaries. In this case, the trust will pay income taxes for the charitable lead trust because the charity is getting the dividends, but they are not for profit organizations, so they don't pay taxes. So the IRS doesn't want you evading income tax by using this trust. So what will happen in that case is the trust itself will pay taxes. And again, we'll talk about how trusts pay taxes in part 2, but they will pay the tax. So they'll get the dividends, they'll pay the tax, and then they will distribute the difference to the charity for as long as you are alive. And then once the person dies, those stocks will go to the named beneficiaries. Life insurance. Life insurance can be used for estate planning. So first of all, as you'll recall, life insurance proceeds themselves are not subject to income tax. So someone dies, you receive life insurance proceeds, no income tax on that. However, they are considered part of the gross estate. So when you're trying to determine, do we have $13,610,000 of assets, any life insurance counts. So if they have a $1 million life insurance policy that's going to their child, the child's getting the money, but the $1 million counts as part of the decedent's estate when you're trying to add up to see how large their estate is. One way you can get around this is by using an irrevocable life insurance trust. Here, a trust owns the life insurance and is the beneficiary of the life insurance. So when the person dies, the money goes into the trust. When that happens, it is not considered part of the estate because it is in an irrevocable trust. It is not part of the estate. And what this can do is give the estate cash in order to pay estate taxes. Remember, we said it is the estate that is responsible for paying the estate taxes, not the one who receives the inheritance. It is the estate. However, what if most of the assets in the estate are not very liquid? In other words, they're not easily turned into cash. If you've got real estate or if you've got a business, well, if that's what the bulk of your assets are, you could have a large estate tax bill. And if there's not much cash in the estate, how are you going to pay that bill? So sometimes what happens is the fiduciary or the executor of the estate ends up having to sell assets in order to pay the estate tax. But sometimes the whole idea of passing the asset on from generation to generation is they don't want to sell it. They want that real estate to stay in the family. They don't want to sell the real estate in order to pay the taxes. So you can use this life insurance as cash to pay the estate tax, thereby saving having to sell property in order to pay those taxes. Life insurance can also be used to equalize the estate between heirs because some assets are difficult to divide equally. So, again, real estate, yes, you could just leave. Let's say a person's got 5 children. You could just leave that piece of real estate to all 5 children. Now they all own 1/5 of it, but that can get cumbersome and it may not really be what the decedent wanted. So maybe they want to leave the house to one child, but they've got their 4 other children. So what they can do is they can get life insurance. And so the child that gets the house, and then the other 4 children get life insurance equivalent to the value of the house. Same thing with a business. Maybe you've got one child who is working in the business, so it makes sense to leave the business to that child. And then you can use life insurance to give the other children cash equivalent to the value of the business. You can also have life insurance with the beneficiary being a charity. If that happens, then the estate gets a deduction equal to the amount of the proceeds. So the person dies, the proceeds go to the charity. The proceeds are included in the decedent's gross estate. But remember, we said they get deductions and adjustments. One of those deductions is for charitable contributions. So even though it's included in the gross estate, it gets deducted. So when you're trying to figure out how large is your estate and is it taxable or not, those life insurance proceeds would not be included. Appreciated assets. We did talk about this earlier, but I'm going to talk about it again and go into a little more detail and give you an example. So if you give appreciated assets, they're going to be treated differently if they are given as a gift versus left as part of an estate. If it is a gift, the recipient uses the same basis as the giver. Remember, this is called carryover basis. If it is part of an estate, the recipient gets a stepped up basis equal to the fair market value of that asset at the date of death, or you can use this other date, 6 months after death, if the executor elects it. But we'll just say, for simplicity purposes, that it is the fair market value on the date of death. What this means is it is usually going to be better to leave appreciated assets as part of the estate rather than gifting them. So let's look at an example. Matilda owns 1,000 shares of stock in XYZ Corp. She purchased those in 1983 for $10 per share. In 2024, the stock is worth $500 per share. And so Matilda then either A, gifts the stock to her son, Matthew, in 2024. Matthew then sells the stock for $500,000. His basis in the stock is how much? $10,000. It's the same as Matilda's. So he must pay capital gains tax on $490,000, the $500,000 sale price minus his $10,000 basis. His capital gains rate is 20%. Therefore, Matthew owes $98,000 in tax on the sale of that stock. Let's say instead we have scenario B. Matilda dies in 2024, leaving the stock to Matthew. Matthew then sells the stock for $500,000, just like before. But now his basis in the stock is $500,000, and therefore he owes no tax on the sale. So you can see the difference, $98,000 in tax because he inherited the stock rather than Matilda gifting him the stock. Now let's talk about tax planning. The truth is, we have talked about tax planning several times throughout these videos when we talked about education credits and filing status. Even that example we just gave about appreciated assets. If you're planning on giving away some stock, it would be a good idea to wait and give that after you die instead of before you die. All of those types of things are tax planning. But for this video, we are going to talk about a few topics in particular. First, we're going to talk about tax projections and estimated payments. Then we're going to talk about income and deduction timing. And then we're going to talk about investing to save. Tax projections and payments. As you'll recall, we talked about needing to make estimated payments. If you've got significant income from sources other than wages or retirement payments for which there's withholding, then you should, preferably quarterly, do a projection for the entire year of income, deduction, etc., for purposes of making your estimated payments. As you'll recall, and I'm sure you've already memorized these, but these are the dates the estimated payments are due: April 15th, June 15th, September 15th, and then January 15th of the following year. When you do these projections, you're going to update them quarterly. You can use these for other purposes as well. So you use them for your estimated payments, but you can use them for all kinds of tax planning purposes and even for business planning purposes if you are dealing with a small business owner. One of the things you will want to keep in mind when you're doing your projections is income and deduction timing. So you want to look at your estimated income and deductions for the year and for next year and see which year might be most beneficial to include income or losses. Now, you do want to remember constructive receipt. You can't just hold on to a check that you received in December and deposit in January and say, look, I don't have to pay tax until next year. That would be considered income in December. However, there are certain times when you have some control over when you receive income that we will talk about. And so you want to look at that. The classic strategy is you want to accelerate deductions and losses and you want to postpone income. So in general, we would say it is better to pay taxes later rather than sooner. So if you can put off income until next year, you're generally better off than including it this year. And if you can include expenses this year, you are generally better off than if you deduct those next year. So that's the classic strategy. There can, of course, be exceptions to that, but that's kind of the general rule that we think about when we are doing tax planning. You do want to consider items that are affected by adjusted gross income thresholds. We've talked about a lot of these as we've gone through the course. IRA contributions, going to depend somewhat on your AGI. Child tax credits, student loan interest deduction, and then passive loss deductions from active participation in rental real estate. That's actually something we'll talk about in part 2, but it is another thing that is influenced by your adjusted gross income. So when you're looking at all of these different things and you're doing this planning, you want to think about when might we want to include income or take deductions based on when any of these things might be applicable. And we want AGI, for instance, to be lower in a particular year in order to take advantage of some of these things. Capital gains and losses. If you have a lot of capital losses for the year, then it might be worth selling an appreciated asset now rather than later, since the gain on that sale will at least be partially offset by those capital losses. So let's say you've had a lot of capital losses, but you've got this one stock that if you were to sell it, you would have a very large gain. Well, you might decide to go ahead and sell that this year rather than waiting to next year, and so that you can offset that gain, or at least part of that gain, with those losses. Because remember, capital losses are limited to $3,000 per year. So they're just going to sit there. Yes, you can carry them over, but they're just going to sit there if you don't use them this year. So you might want to do that. Now, of course, there are lots of things to consider besides income taxes. I am not suggesting that somebody should sell a stock, for instance, just to get a tax benefit. If they really believe in that stock and they want to hold it for the long term because it's a good investment, then that's more important than the tax effects. So they should hold on to that stock. But sometimes you've got taxpayers who are kind of on the fence and they're like, well, maybe this has gotten as high as it's going to get. Maybe I should go ahead and sell it. And they can make that decision. So your job is just to let them know of the possible strategies, and then they are going to make the decision about what they do about it. Now, you could have the opposite situation where you don't have any capital losses. So you might be better off just waiting to sell it until next year. So maybe they've got this stock that they think, you know what, I think I want to sell it. And you can talk to them, and let's say it's December. You can say, hey, if you think that this is going to hold its value here for a few more weeks, then you might just want to wait until January. So that way you're not taxed on it until next year rather than being taxed on it this year. So that might be a strategy that you could use as well. And then also with appreciated property, you might want to donate that item to charity because remember, if you donate it to charity, you get a deduction equal to fair market value of that asset, but you don't have to pay any tax on the gain that was built into that asset. Other timing considerations. You can take distributions from retirement accounts in the year that benefits you the most. Now, you could have required minimum distributions, but we're talking about above and beyond that. You really can take your distributions from your retirement accounts when you want to. So you can take it this year, you can wait and take it next year. So you want to consider that when you're doing your tax planning. Would it be better to take it this year, or would it be better to wait until January and take it next year in order to qualify for the most tax benefits and result in a lower overall tax? Of course, you have the qualified charitable distribution from an IRA. If they're going to give to charity anyway, then they can avoid tax on the distribution by doing a qualified charitable distribution. If you own a small business, you often have some control over when you get your salary and especially your bonuses. Now, you do have to pay some salary. We'll talk about all of that in part two. But for now, just know some business owners will pay themselves a salary all year. And then at the end of the year, they'll see how did we do? How did the business do? And if the business did very well, they may pay themselves a bonus. Well, they generally can decide, should I pay that bonus now in December or should I wait to pay it in January, for example? So that would be another thing that you could time depending on what is best. And then also you can do the same sort of timing things with itemized deduction. We call it itemized deduction bunching. So some itemized deductions you can control when you pay them. So for example, charitable contributions, even medical procedures. Some medical procedures might be elective, so you can wait to have them until next year, or you could have the surgery, say in December, but the bills won't come due until January. Of course, we're on the cash basis. So you would get that deduction when it was paid rather than it was incurred. But you might want to see, well, can I put a lot of these deductions into one year in order to get the largest deduction for the year? And these days, we have historically a very large standard deduction. So it might make sense to put as much as you can into one year, get a large itemized deduction. Then the next year, maybe you don't have as many deductions because you moved them all into the previous year, but now you can take advantage of the standard deduction. So that's the kind of thinking that we do when we are doing this planning for our clients. Invest to save. So there are ways to save on taxes by making contributions to certain kind of plans. So first of all, you've got employer-sponsored retirement plans, IRAs that we've talked about, health savings related accounts, 529 plans, Coverdell plans, and ABLE accounts. So we are going to talk about each of these. Employer retirement plans. So these are your 401k, 403b, etc. So here are some numbers you want to know. In part two, we are going to talk about employer retirement plans in some detail. But for part one, you want to know these maximum contributions that are allowed. So for 2024, the maximum contributions that can be made to these employer plans is $23,000. If you are age 50 or older, you can make an additional $7,500 contribution for a total of $30,500. So those are those catch-up contributions like we have with the IRA. Except with the IRA, it's only $1,000. With these plans, it's $7,500. So you will want to know those amounts for the exam. If you have a traditional, in other words, not a Roth plan, then those catch-up contributions of $7,500 are only allowed if your wages were not more than $145,000. This is new for 2024. So take note of this. They might test this on the exam to see if you know the new rule. So if you make $145,000 or more, even if you're over age 50, you cannot make that extra $7,500 contribution. You would still be limited to the $23,000 contribution. Also, just remember that contributions can be of up to 100% of your compensation. So, for example, if you earn $20,000, your contribution is limited to $20,000. In other words, your contribution is limited to the lower of your compensation or $23,000. That's what that is saying. Also, employers will often match part of your contribution. So if you put in some money to your 401k, your employer may match it. Those matching contributions are also tax free. So it makes these employer retirement plans that much more attractive. And then also for lower and middle income taxpayers, you can possibly get that savers credit that we talked about for making contributions to these plans. Next is a SEP or a simple IRA. So these are these business related IRA plans. If you have a SEP, a self-employed plan, then the business can contribute up to $69,000 or 25% of compensation, whichever is lower. So you can contribute, if you're self-employed, you can contribute 25% of your compensation up to $69,000 into one of these SEP plans. Because it is a self-employed plan, there are no employee contributions, no separate employee contributions. You are both the employer and the employee. So these are just all considered employer contributions. For the simple plan, the savings incentive match plan for employees, you can contribute, this is for employees, they can contribute up to $16,000 per year for 2024. If they are age 50 or older, they can contribute an additional $3,500, and the savers credit is available for those lower income taxpayers. IRAs, we did a whole video on IRAs. This is just a reminder. You can contribute up to $7,000, $8,000 if age 50 or older. That applies to all of your IRAs, no matter how many you have, no matter if they're traditional or Roth. Those are the maximum contributions, and you can get the savers credit for making those contributions. Health savings accounts, or HSA. This is a pre-tax savings account for healthcare expenses. So typically, if you have an employer that offers these, they may allow you to make contributions to a health savings account. If they do, they come out of your paycheck and it comes out pre-tax. So you're not paying tax on those amounts. It's similar to a 401k contribution to a traditional 401k plan. Comes out before tax. Any distributions from that plan that are used to pay qualified medical expenses are tax free. So you put the money in pre-tax, you take the money out without having to pay tax. So this is a great deal. One condition of this is you have to have a high deductible health insurance plan in order to have an HSA. What does high deductible mean? Well, if you are insuring only yourself, the deductible has to be at least $1,500. If you are insuring yourself and at least one other family member, then the deductible has to be at least $3,000. So you will want to remember those. High deductible, $1,500 at least for self only, $3,000 at least for self and at least one family member. So how much can you actually contribute to the HSA? If you have self-only coverage for 2024, you can contribute up to $4,150 per year. If you are age 55 or older, not 50, but 55 or older, you can contribute an extra $1,000 to $5,150. For family coverage, your maximum contribution is $8,300, which of course is twice the amount of the self-only coverage. If you are age 55 or older, you still get $1,000 extra, so you can contribute $9,300 in that case. What this does is it effectively makes healthcare expenses tax deductible because the money is coming out without paying tax from your paycheck. And when the money comes out of the HSA to pay your medical expenses, it is not taxed. So those medical expenses have become tax deductible. By the way, you do not have to be an employee to have an HSA. I use that as an example, but you could be self-employed and get an HSA type of health insurance account as well. And instead of coming out of a paycheck, you would just be contributing amounts to that account periodically, and it works exactly the same way. You get a deduction for making those contributions, and when the money comes out, you do not have to pay tax on it. Another nice thing about the HSA is it is not a use it or lose it account. In other words, you put the money in there, you don't have to use it all this year. Any amounts that you have left that you did not use to pay medical expenses rolls over to the following year, and it keeps rolling over and rolling over. It can roll over for your entire career. So you can put in the maximum every year, use it as you need it. Whatever you don't need, you don't use, just rolls over. You can go all the way to retirement. Once you reach retirement age, now you don't even have to use the money for healthcare expenses. You can treat it just like a traditional IRA. So this is a way to contribute more money for retirement and use the money as needed during your working years to pay for medical expenses. So it really is a good deal. The next health related account is a flexible spending account. This is an employer sponsored plan. You make pre tax contributions to this FSA account. The maximum amount of the contribution in 2024 is $3,200. However, this is a use it or lose it account. So if you put in the maximum $3,200 and then you only use $2,500 during the year to pay for healthcare expenses, then you just lose that extra $700, which obviously is different than the HSA where it just rolls over to the next year. Now, one benefit of the FSA over the HSA is that you do not need a high deductible insurance plan. So a lot of people don't like having that high deductible, so therefore they can't do an HSA, but they can still use the FSA. They just have to remember that they need to use all the money by the end of the year. Dependent care FSA is the same idea as a healthcare FSA, except you use the money for dependent care expenses. So it's pre-tax again from your paycheck, goes into an account. You use that money to pay dependent care expenses. The maximum contribution to this one is $5,000 or $2,500 if you are married filing separately. And again, it is a use it or lose it type of account. Section 529 plan. This is for educational expenses. It's also called a qualified tuition program or QTP. We usually just call it a 529 plan. So this is a plan that is set up to provide for the education of whoever is named as the beneficiary. Contributions to it are not tax deductible, but they grow tax free. And as long as the distributions are used to pay for qualifying educational expenses, then the amount is not taxable. This can be used to pay for higher education expenses, including tuition, book fees, equipment, and reasonable room and board. And that used to be all you could use it for. You couldn't use it for anything else. But now you can. You can also use up to $10,000 per year for K through 12 tuition. Now it's tuition only, but still you can use $10,000 a year to pay that kindergarten through 12th grade tuition. You can also use $10,000 to pay off student loans that you may have. If you take the money out for a purpose other than qualified education expenses, then you will have to pay tax on that amount and a 10% penalty. A Coverdell Education Savings Account, also called a Coverdell IRA, so it is a type of IRA. These contributions also are not tax deductible, but they do grow tax free. And as long as the proceeds are used for education expenses, then you don't have to pay tax. It can be used only to pay for higher education expenses, including tuition, books, fees, equipment, and reasonable room and board. So no using it for K through 12 tuition or to pay off a student loan. Contributions are limited to $2,000 per year per beneficiary in total, no matter who makes them or how many of these ESAs are set up. Any excess contributions are subject to a 6% excise tax. And this can happen pretty easily. You may set up this account and you let the grandparents know about it, and the aunts and uncles, and various people may decide to make contributions to this account. So it could be that you get over $2,000 accidentally. So if you do that, you're going to have to pay a 6% excise tax on the excess. So you want to get that money out of there as soon as you can, as soon as you realize that the mistake has been made. There are no contributions allowed once the beneficiary is age 18, and the balance must all be distributed by the time the beneficiary is age 30. And contributions are phased out for people making the contributions if their AGI is between $95,000 and $110,000 if they are not married filing jointly, and for double that amount if they are married filing jointly. And again, if you use this money for anything other than qualified education expenses, it is subject to tax and a 10% penalty. ABLE account. So this is Achieving a Better Life Experience account, also a 529A account. These are set up to provide for the qualified disability expenses of the beneficiary. The contributions can be made by the beneficiary themselves and by others. Amounts can also be rolled over from a 529 plan as long as the total contributions are within the annual limits. So let's say you set up a 529 plan for a very small child, and then somewhere along the line, unfortunately, they become disabled. And so they're not going to be able to take advantage of that extra education that they might have had if they were not disabled. Well, you can roll those amounts into this ABLE account and use those funds instead to help pay for their qualified disability expenses. Now, the annual contributions to the account are limited to the annual gift exclusion amount, which, of course, in 2024 is $18,000. The beneficiary of the ABLE account may be able to contribute additional amounts over that $18,000 up to their total compensation or the poverty line for a one-person household, whichever is less. This is only available if the beneficiary does not participate in an employer retirement plan. So generally limited to $18,000, but if they are able to work, then they can put the excess in as long as the amount that they put in is not more than the poverty line for a one-person household. Any contributions that the beneficiary makes are eligible for that saver's credit as long as they otherwise qualify. Contributions are not tax deductible, but they grow tax free, and distributions are also tax free as long as they are used to pay for the qualified expenses related to the beneficiary's disability. And that, my friends, is the end of video 7 and part 1, individuals. Congratulations to you. Good luck on your part 1 exam. Study the slides. Watch these videos again if you need to. And I will see you in part 2.